quality is not just an act, it's a habit, and it is remembered long after the price is forgotten. And all the business that you do, it's not just a work that you do, it is the value that you create in the process. Hi, this is Ritika, and we are doing reading 28th of Corporate Finance, now known as Corporate Issuers, that is, Uses of Capital.
We are now on LOSC. This LOS requires us to describe expected relations among a company's investments, company value, and share price. So we just have to briefly describe and not explain the details. And before we begin, what is ROIC? It is Return on Invested Capital. ROIC is a calculation used to assess company's efficiency at allocating the capital under its control to profitable investment. The return on invested capital ratio gives a sense of how well a company is using its capital to generate profits. Now, what is the relationship between NPV and a company's value? We have discussed what NPV is and how it is calculated in the previous video. NPV has a direct impact on the stock prices of a company. And the value of a company is the total of the value of its current investments plus the sum of net present value of all its future investments after considering any externalities. So how is NPV related to a company's value? If there is any new investment by a company, its returns in terms of NPV should be higher than expected. If they are, the value of company will rise, and if it is not, then the stock price will fall. It should be noted that a company would always select a project with positive NPV. Now, what is the relationship between ROIC and company's value? If the return on invested capital of a company is higher than its cost of capital or COC, then the value of the investors increases. That is simply because the returns are greater than the costs. On the other hand, if the ROIC is less than the COC, the value of the investors decreases. And that is mainly because the company is now not even generating enough returns to cover the cost. Moving on, what is the relationship between inflation and company value? Inflation reduces the value of depreciation tax saving to the company, effectively increasing its real taxes. So what happens during the period of unnaturally high inflation is that the value of fixed assets also increases. Now, since their value has increased, the amount of depreciation should also increase. But that does not happen as it's valued at the cost of acquisition. And since the amount of depreciation is less than it should be, the overhead costs are low and hence the taxes are high. If the level of inflation is higher than expected, the company's actual profitability is also low because of the higher price of raw material and overhead, thus reducing its value. And vice versa for lower than expected inflation. Inflation also impacts the amount of tax outflows. When there is a permanent increase in the rate of inflation, the nominal interest rates also rise by an equal amount. This lowers the real after-tax returns and thus lowering the wealth of the company. The impact of inflation is not same and uniform on all the costs and revenues of a company. The impact of each item that forms a part of profitability should be analyzed separately to assess the impact on profitability and value of the company. Having said all that, it is not that inflation only has a bad impact on all the companies. There are certain stocks that perform better during the high inflation periods. The value stocks perform better during the inflation, whereas growth stocks do well during low inflation. When inflation is on the upswing, income-oriented or high dividend-paying stock prices generally decline. Stocks overall seem more volatile during the high inflation period. Next is the relationship between quality of management and company's value. The investment decisions and the asset allocation policy of a company should reflect two things about the quality of management. The first, the degree to which the management embraces the goal of shareholders' wealth maximization. This shows how good is the intent of the management. And B, the effectiveness of management in achieving such goals. This reflects the capability of management. So, the presence of both good intent and efficacy are equally important. Just like good intention without efficiency are useless, capability without good motives could also be equally dangerous. If there is a positive indication about the willingness and effectiveness of management that is reflected in the investment policy, it will positively impact the value of the company and its stock prices. So that was LOSC. I hope the factors that impact a company's value are very much clear. If, however, you have any queries, you can contact us. Check out the complete study material and practice questions on our website ProCFA.com. The link is in the description. Take care and study hard.